Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London UK feed wheat. Paris milling wheat. There had been here one continuing dominant pattern, a quite large pattern, that 12 weeks ago took a break on the downside. It is, of course, the dark blue highlighted late August 24 to late February 25 ascending triangle pattern. This pattern had the requisite combined 5+ touches and is made up from a lot of smaller patterns within it. But the main pattern can be clearly seen on my daily chart. 13 weeks ago I laid out targets below for this pattern, and I quote, a primary target X would be in the 226 zone, with a secondary hard to reach target X1 down in the 194 zone, end of quote. 12 weeks ago the market reached the primary target X, pushing down below it. However, we had a stall in the movement lower during the first part of March, prompted by the market trying to test down towards the 50% absolute Fibonacci line at 219. This action will become very crucial to what happened next, beyond the obvious significance of it being an absolute 50% Fibonacci line. You see, it had importance because it helped hold up prices back in November and early December last year, and also eroded the bearish incentive back in August and September as well. The reactionary rise only managed to move up to the gold long moving average overhead, currently at 226, not even testing it, but rejecting further upside pressure, and we dropped lower after that, more or less down to lows that were not seen since March last year. Anyway, 12 weeks ago I amended the still open further targets below into target X1 being at 205 as a secondary target to reach, and target X2 being a tertiary target, and even harder to reach target down at 194. I asked the question back then, and I quote, the question still remains as to whether prices will take this time to form a possible bearish halfway hesitation, or will they recover further. The latter seems unlikely right now, and the former, well, is too early to say, though it might comply with what is going on in the other grain markets, end of quote. I added 6 weeks ago, and I quote, comply? Well, the market did, as we've dropped down through the 50% absolute Fibonacci line and shown a new close-in target X4 for the bearish halfway hesitation down in the 206 zone, which I have since finessed to the 208 zone. This was the most immediate opportunity on the downside, end of quote. 4 weeks ago prices reached target X4 at 208, and 2 weeks ago they reached target X1 down at 205. This just left the tertiary and much harder to reach target X3 down at 194 still open. I said earlier that the action over March was going to be very significant. Well, you can see by the bright green March-based bearish shift pitchfork that it was, as this pitchfork became excellent at showing the bearish angle of attack of the market from March until 2 weeks ago, when we had a changeover. Prices then gapped up over the bright green upper tine, and this week pushed up through the 50% absolute Fibonacci line at 219. The green flat lining short medium moving average currently 216, and even the May 23 low at 221, though so far the market has only managed to seemingly stabilize over the green short medium moving average. This new development gives a whole new series of market dimensions to contemplate and see what may be affecting the market. It will take some time to study, but I suspect the tertiary, so hard to reach target X2 below, may now be out of reach. Instead, I'd concentrate on looking at the 50% absolute Fibonacci line and the overhead declining mauve medium moving average currently at 224 and the gold long moving average currently at 226. Minneapolis wheat. We had one key pattern to look at here and a number of newer patterns and levels to discuss as well. The key pattern is the previously highlighted sideways triangle, created by the stalwart overhead dark blue July 23 to date downtrend, which remains unaltered, currently at 610, though breached at least, and the bright green early March to mid-May uptrend. After some hesitation over the last few weeks, prices finally pushed lower 2 weeks ago, down to the slightly realigned September 2019 to date uptrend, currently at 573, and the bright red lower tine, currently 570 of the newly drawn bright red bearish shift pitchfork, which I will detail shortly. This was all before a changeover gap moves prices higher. Now, there is no bearish halfway hesitation to consider here, as seen elsewhere in other markets, nor is there a 38.2% absolute Fibonacci line nearby, as that is down at 537. So it was a straightforward attempt lower, though we also had support down there at 578, and in the congestion seen between November 24 to January 25, between about 585 to 611. Now, there are a couple of other features I'd like to expand upon that may help in deciphering what is going on here. So 3 weeks ago I drew a bright red mid-March to mid-April bearish shift pitchfork. I said at the time, and I quote, "This seems good right now despite its young age at showing the bearish angle of attack," end of quote. And good it has sort of been, as prices have stayed, well, they have stayed just about in between the bright red lower time below, currently at 570, and the breaching, not closing yet, but very close to, over the bright red upper tine above, currently at 618. This is a much more shallower pitchfork, bearish pitchfork, than elsewhere. All this action left us, until this week at least, with some targets below for the first pattern, the original sideways triangle, and we have a primary target X in the 562 zone, and a secondary hard to reach target X1 down in the 520 zone. I said 3 weeks ago about these two patterns, or these two targets I should say, and I quote, "I am not too sure about these two, but for now they will do," end of quote. I am even more unsure about these targets below, as this whole move down could just be a quite large false break, and we might in the next few sessions break on the upside with a new pattern. However, for now I will still leave these there for the next week or so, but I am especially mindful that prices have pierced on the upside the flatlining mauve medium moving average, currently 610, and the flatlining gold long moving average, currently 614, and prices seem to be trying to stabilize over both, so caution, deep caution. London UK feed wheat. There continues to be here on this daily chart, even now, these many months, close to 1 year even, only one major significant pattern here. Something we've not seen in the other grain markets, and that is the bright red late May to early July 2024 bearish shift pitchfork. The market in late February this year reasserted the dominance of this pattern, with prices then breaching, then repairing an attempted break higher over the bright red upper time, which is currently at 174, back in late January and early February. Add to this the earlier this year narrow mix overhead of all the moving averages, though they are now separating out, as well as the 50% absolute Fibonacci line at 180.5, and you had, and I suppose still have, an area overhead that, as I've repeatedly said for months and months, that had been brewing up for a significant move, which happened, or should I say started to happen, over late February and into March. It was, as I said 24 weeks ago, and ever since, and I quote, "Even now, still looking for that better pattern to appear, and until that shows up, I will continue utilizing this bright red pitchfork," end of quote. So, my point has been, and still is, that the bright red pitchfork was, and is, after all these temptations of other patterns, still the key pattern I was looking for all the time. This leads me to my final four points, and 3 of them was something that I noted in my recent annual, well not so recent now, annual commentary on London feed wheat. Firstly, I saw there the potential for a very large May 23 to date cat's ears pattern. This is a bearish pattern, akin to a double top formed after a big fall, such as the fall we had earlier in 2023, as well as an even longer term second pattern, an August 2020 to date very large head and shoulders top pattern. These two super long-term patterns are still live, and they both rely on one feature. That is their common neckline on my daily chart, currently at 167 3/4. For most of March, prices slid along the top of this support of these pair of necklines all in one. However, recently we have dipped, recovered, and then again 4 weeks ago dipped again below the neckline, setting up the opportunity for a recent bearish halfway hesitation with a potential target X in the 151 even zone, and at the same time making the lowest lows and low closes since March last year. The third feature is a little more longer term. It is the March 2016 to date, recently finessed and finessed again last week, dark blue uptrend, currently at 155.10. For the last few weeks we had the market pressing on the necklines as well as this uptrend. I said 3 weeks ago, and I quote, "It looks right now as if we are finally breaking below it, as well as pushing down through the congestion between March to April 2019, between 161.95 to 165 3/4, end of quote. Well, we finally did push down below it, as well as below for the first proper time since July last year, below the bright red middle time, currently at 156.20, though we have not stabilized below it as yet. We now have support below at the February 24 low at 154 even, which held up prices this past Monday, and the March 24 low at 153.65. I did say last week that it would be interesting to see how the market treats these two. Right now it seems we are getting set up to have this week as a possible weekly key reversal. Thus, if tonight, and it looks like it's happened, we see prices close either over 155.95 or under 155 even, would be on. Anything in between would have a lesser outside weak pattern. It looks like now we are looking at an interesting and reactionary possible weekly key reversal up. Now, going back a little bit, I have said here repeatedly there was one major possible severe criticism of the two necklines, and that is they had been previously breached, and some would argue broken. However, I counter that by saying that I transposed these from my longer term monthly charts, and whilst on a daily and even on a weekly chart they may appear breached and broken, on the longer term monthly charts where they really live, they did look still somewhat valid. And as I've said repeatedly, and I quote, "I would not take these as cast iron lines in the sand that should not be crossed, but as longer term strategic patterns that we should bear in mind and occasionally bring a closer eye upon, such as now," end of quote. Now I added 3 weeks ago, and I quote, "This week is the first week in quite a while when I really think we have broken the back of this support. We have not only had a significant monthly close below these key necklines, but we also did it with a monthly key reversal down. Now, 1 month does not make a major change in my monthly chart, but it does set up the situation to see if May and even June will follow through lower. Watch this space," end of quote. I still stand by those words. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpick and ADM Investor Service International Limited. And here comes the final important bit.